Learning objective 4, we're going to look at how things change as the assets kind of live their lives through with the company. And we'll look at asset sales in terms of gains and losses, asset impairments in terms of what happens when the value drops in a particular asset. And third is what happens if you have to do a major shift in strategy. Things aren't going well or things could be better and you want to realign your company accordingly. Asset sales, the formula is actually very straightforward to compute the gain or loss on a sale. The gain or loss on sale equals your sales proceeds minus your book value of that asset. That's it. If we had that machinery from the earlier example, if we sell it for $50,000 in some time during its life, we would look up what is the book value at the moment we sold it, subtract that, and if the sales price is higher than our book value, we made a gain on sale. If we sold it for less than our book value, we had a loss on sale, and that's it. We would record it as follows. We would eliminate the asset, so we would subtract out that $100,000 asset from gross, which we never touched the whole time. Then we would eliminate whatever we had depreciated previously for that specific asset from accumulated depreciation. And then on the income statement, we would record the gain or loss depending on the things we just mentioned, on the price relative to the net book value. And so that's it. We would take out the asset, take out the accumulated depreciation, and on the income statement, show the gain or loss on the sale. Impairment. Impairment when something's hurt, like my sight is impaired, I can't see as well. So that's impairment. Same thing holds for assets. So if assets go down in value and it's gone down in a permanent way, then GAAP requires us to value it at market and write it off. Here's the flow chart. If the sum of the cash flows, and this is our typical way of valuation, is lower than the net book value, then we would deem it impaired and write down the value. If it's not, we just leave it alone. If the value's gone up, by the way, don't mark it up. It can only go one direction, down. So the assets are there. It can only go down in value with an impairment, cannot go up. And we're talking about PP&E here. Here's an example of Chesapeake Energy, and they saw that oil prices dropped during 2015, and it was big. It was from $95 down to $50 a barrel, and so that drop caused their properties that they spent a lot of money buying the mineral rights to properties, those went down. When they analyzed the value of those properties with the new lower market values, it was a big drop in value, and they took an impairment charge of $18 billion. So that is a painful example of an asset impairment. Restructuring is when we make a decision, and they're usually large strategic decisions, to either turn around a company or do something specific to greatly enhance the future outlook for the company. And when we do that, we do something a little unusual. We get to record everything up front. We will look at what does it cost us to affect this restructure. We might eliminate business segments, sell assets, downsize, cut down our workforce, or reconfigure debt. These things might all be parts of a restructuring plan. What happens when that occurs is we get to accrue expenses in advance, even before we did it. When the board approves a restructuring plan, the company can set up a reserve for all these costs that I just mentioned and then take the charge immediately and not have to wait for when those expenses are actually paid. It's when they say they're going to restructure, they can estimate the cost of the major restructuring and take the hit on their income statement immediately. An example is if we have employee severance. Severance is when you pay employees some money when you lay them off so that it can help smooth the transition into a new job. Or we have relocation if you relocate someone to a market where we think they can get employed. So we estimate the total cost. That total is accrued in that restructuring expense. And then now we have a liability account that is held for future expenditures to pay for these anticipated expenses. An example here of Pfizer is that they had a disclosure about their restructuring charges, and we could see that they had a balance here of termination costs of $1.7 billion. They added more. Provision means you add more. They added more estimates of $68 million, and so they ended up with a large balance, but they used $600 million. this restructuring occurred over a number of years, and so you can see that they're adding to it, but they're also spending money against their liability account. It's pretty hard to analyze because we don't know all the ins and outs of that restructuring, the decision, and why they did so. We can just look at what information is provided, which is the magnitude of the charge and this liability account, and whether they are indeed using that money to affect the restructuring or not.